Hi, I'm your host, Sophocles Sophocleus. On this podcast, we discuss interesting stock ideas from around the world. The goal is to have meaningful discussions by getting into the numbers and better understanding the opportunity. Thank you for joining us. This podcast is being made available for educational purposes only. It should not be used for any other purpose. Full disclaimer at the end of the podcast. I'd like to welcome Arthur van der Linden from Grit Capital. He's founder of Grit Capital, running two investment vehicles, the Grit Multifactor and the Grit Variant View. Since 2008, he's been heading RMA's group's mergers and acquisitions in Asia, emerging markets, and frontier markets. He started at Dow Chemical and has a master's in chemical engineering from Delft University of Technology in the Netherlands and an MBA from Columbia. And it seems that we have a growing group of Columbia alumni at the Cypress Value Investor Conference this year, and they seem to have swept the awards for the best performing ideas. And I wish Arthur's ideas to do similarly well going forward. Well, Arthur was very kind to share this idea of his with all of you. I hope you enjoy it. Welcome, Arthur.
Yeah, thanks, Sophocles. It's been a long time. Just a week ago, we were having beers in beautiful Cyprus. So now we're split halfway across the globe.
Yes,
Yeah.
yes, indeed. But it was great to have you. Thank you for coming, Arthur. First off, what's your elevator pitch?
The the case is quite simple. I mean, we have a collision repair roll up that's was very successful at one stage. Then had a buyout bid from Blackstone, so probably doing something good. Has a billion in Australian dollars of revenue, which is around, let's say, 600 million of US revenue. So this is a roll up that was once upon in a good position. Then since COVID, basically the wheels came off, and it's a small cap dumpster stock. But if you believe that the problems are solvable, then you still have a growth story and a roll-up story in a fairly attractive market. The company is the biggest collision repair operator in Australia by a long shot. So they have 140, let's say, outlets, and the biggest competitor is around 30. And there's certain scale advantages. So this business is an interesting business. It's a simple business. In my view, it's been mismanaged. They've made some fairly basic and fixable errors. So what do you have to believe? We can get into that more details, but basically you have to believe. Well, the current EBITDA is roughly 50 million. If you do a 9 times EV to EBITDA multiple, which is kind of customary in the industry, you have a 450 million dollar market cap, or sorry, enterprise value. The net debt at this point in time is zero. There are 5 billion shares, so basically you have a 8-9 cents stock price, and today the stock is at 6 and change, whatever it is today. So that's the story. Then of course there's upside on the EBITDA side, and so I believe that 2-3 years out, this could be probably a 3 times return in a fairly attractive industry, and with a business that's by far the biggest collision repair operator in a fairly contained market, right? Australia being kind of this, well, it is literally an island, right? So
That's without adding back the leases. So if you back the
correct.
leases, it gets up to probably around 90 to 100 million,
Yeah,
if I'm
yeah,
not
exactly,
mistaken, right?
exactly. Yeah.
Okay, so that's just for people listening in. If they want, they can do it with or without the leases. I actually did that calculation yesterday when I was looking through the company.
Mm.
It doesn't really make much of a difference. I guess it only really you'd only probably take that into consideration if you're worried about them meeting, if they can, make sure they can meet those lease obligations. So that's up to each individual
Right,
investor
but it
how
is
they
a
want to
real
how
expense,
they want
right?
to deal with that. Yeah, yeah, yeah. No, 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 for sure. So just taking a step back, collision repair. So I'm in a car accident. I call my insurance company, and they say to me, "You have to take it to AMA." So is that how things work in Australia? Or do
they're kind of several different scenarios. Presumably, you're insured, right? Because that's the law. So, and if you look at AMA's business, 80% plus of the business, their clientele is effectively the insurance company, right? So the insurance company, there are two situations. One, you have a drivable repair, and the other is you have a non-drivable repair. So if it's a drivable repair, then you're right. The the customer or the insurance client has to go to an insurance approved collision repair center. Now that could be AMA, could also be somebody else, but generally speaking, the insurance company has the best deal with AMA and would request or would have a strong preference to get the customer to drive to the AMA service center. Now the other situation is when you have a non-drivable repair, then there's a little bit of and gets a little bit murky, and then the tow company will drag it to generally speaking, to the nearest collision repair center. And that gets kind of murky because then there could be hidden, under the table incentives for the tow company to bring it to one and not the other. But there again, there would be preference from the insurance company perspective to bring it to an approved center. However, if the car finds itself at a non-approved center, then it's kind of a schlep to pull it away to somewhere else, right? So it still gets repaired despite being at a at a center that they would rather not have the vehicle.
do you know? Well, since AMA is largest, do you know if they have brand value that do Australians know AMA and say, okay, I'll prefer to go to.
Yeah, I mean there is some brand value, but it's fairly limited. They actually run, well, their drivable repair centers are called Capital Smart. They're not even called AMA. So, and then the other collision repair centers are called, well, have the AMA brand in them. So I would say there's a little bit of value, but that's not really the driver here. What is true is that generally speaking, the customer has a preference to go to somewhere where they feel their car is going to get repaired properly, right? And the insurance company has an incentive to get the customer to feel that they're bringing their car to somebody that that's well organized and that treats the customer well. Now, this has traditionally been a fairly fragmented business, so there are a lot of mom and pop shops around. And then you never know, right? Some guys might be very service oriented, but some guys may not, right? So having the sort of standardized customer interface that AMA provides, definitely from an insurance perspective, is what the insurance company wants. And you can see in other markets, for instance in North America, that it's actually the insurance company that's been driving this consolidation.
Oh, because
So
they prefer to talk with one company rather than talking with multiple mom and pops. And I think you mentioned when I was talking to you about this in Cyprus, the insurance companies have integrated their tech with the AMA. Is that right? Is that for all the different brands that are under AMA, or is that with Capital
Yeah,
Smart
so
or
so
something?
there's definitely there's an advantage for the insurance company. It's definitely an advantage to deal with one customer. So there's a couple of things. One, the insurance company wants to make sure that their customers, the insurers, are getting good quality and good service because if there isn't good quality and service, then it degrades the insurance brand. So they want to have that controlled. So there's a preference to go with something like AMA versus the mom and pop. The second thing is AMA gives the service at the best price, because they have the ability, to purchase. They have the purchasing power. That they invest in the computer systems so that they can integrate with the insurance companies, and the insurance companies can give the feedback to their customers about when the car will be repaired, and what's being done, and what the so there's that aspect. And all in all, and it's hard to find the real number, but it's estimated, and I've seen it written up in various ways and forms. But basically, the fact that AMA is around gives the insurer probably a 10 to max 20% cost benefit on their claim repair cost, right? So that's quite substantial, right? If you compare that to a mom and pop shop or a smaller operator, that's a pretty significant saving. And the other thing is, the there's a pretty lengthy negotiation going on between the insurer and the collision repair companies, because a lot of the work gets contracted not on a job basis, but it's sort of, they say, okay, a scratch of this size is going to get, we're going to give you $100.
EMA needs the insurance companies, and like you mentioned, there's two big insurance companies that have like 70% of the market.
Yeah.
So that gives them a lot of power, which makes AMA's position a little weaker in this case. And with all this competition of what is somewhat commodity, AMA would have to have, I think, cost advantage. Are they? Do you know? Are they the low cost repair shop?
Yeah, they were definitely in the past, pre-COVID, let's say. Post-COVID, they lost that edge. Various expenses went up, and they didn't adapt quick enough. Headquarter expenses went up, and so they kind of lost that edge. But technically speaking, they should be the lowest cost operator because they are the biggest. They have the biggest skill advantages. So AMA should be in that position. Now, the Australian automotive insurance business is a duopoly between IAG and Suncorp. So there is a very fine negotiation. It's kind of, the one needs the other. AMA is very dependent on these insurance companies, and if they would lose a contract with either, it would be detrimental to their business. But there's also the other side is, okay, AMA being the biggest, it's not like these insurance companies could immediately find somebody to replace AMA. Plus, you have to consider what I just said, is that if they go to somebody else, the cost might be anywhere from 10 to 20% more expensive. So yes, it's a commodity business. The insurance company just wants the lowest cost operator that provides the service. Right? They don't really, care if it's AMA or somebody else. But okay, AMA happens to be the biggest. They can provide the lowest cost, and they provide the best service. So everybody else is kind of, subpar or
Okay.
to.
So there's really, I think, then there's the risk that, I guess, if the other mom and pops get together and form another big group, or if someone else goes into Australia and has, or someone in Australia has deep pockets and starts, just copying the strategy of doing a roll up, but they're much better financed, that is a risk here. Do you think?
Correct. So have some of the smaller guys been doing what you said? Yeah. So you can see that, well, AMA has 140 outlets, and there's a company called Repair Hub that has 30 or 35, whatever it is. So, but there's a lot of consolidation going on, and in fact, the mom and pop shops are all suffering and basically losing the race. So you have companies with 3 outlets, 5 outlets, 10 outlets, 30 outlets. So there's definitely that dynamic going on. Outside, coming into Australia, you can establish a local monopoly in Australia without getting the attention of maybe a well-capitalized American company or European company, because it's kind of far away, right? But it's far away. It's an esoteric market. So if you're Starbucks, or what's number 1 to 10 on your list. It's not Australia. It's going to be China or something. The international expansion goes elsewhere before it comes to Australia. So it's kind of left alone. However, what's interesting is Blackstone did come into the market and tried to take AMA out right a couple of years ago.
Hmm.
So is
At
there?
like wasn't it like 11 times EBITDA, which significantly
Yeah,
higher than what it trades today.
yeah, it's 11 times EBITDA, but
And also, I think part of the consolidation is what probably even drove some fear within
yeah,
AMA itself to do a big acquisition in what was it 2000
2019, yeah.
2020
No, 19.
2009, was it 19? Okay, so 19. So they did a big acquisition, and that really hurt their balance sheet because of all the debt they took on, and then COVID hit. Which I looked at some of the press releases, and it seemed they talked about something like 10 times EV to EBITDA.
Hmm.
Doesn't sound so ridiculous. It's not like some of these M&A deals you hear in the U.S., which is more like 50 times revenue. Do you think that was um, too expensive,
Yeah,
or was that you thought it was too expensive versus what they did in the past?
yeah. Okay, so that deal is very critical, and you hit on it correctly because it was kind of a shotgun marriage, right? In a way, they had to do it because if they wouldn't do it, it was basically they bought 50 outlets, right? So they went from being the biggest to being the absolute biggest. If they wouldn't have done that, then maybe a private equity company, maybe Blackstone, right? Because Blackstone did the deal, did the offer to AMA a couple of months earlier, right? So there was the threat of somebody buying this asset, rather than AMA. So yeah, you're right. It was fear, and they got beaten up for buying it. But I think at the time, there was certainly rationale, and it was their biggest acquisition ever, and they loaded their balance sheet up with debt, and on the overpayment, okay, the press releases, honestly, they are telling a half truth. In actual fact, the real EBITDA multiple that they were paying was probably 13, 14. So they were selling it as a 10 times EBITDA multiple after the
Synergies.
synergies and bullshit. the, the the stuff that the investment bankers tried to drum up, to dream up, so that this deal became palatable to the press, right? And
Mm.
so in actual fact, what happened was these so-called synergy bill 400 million of additional debt, and that was an absolute disaster. So were they was it the wrong move? Were they unfortunate? I'm in the camp that it was a bold move that they probably had to do, and they were just very unlucky with COVID hitting immediately afterwards.
Revenues never went down. Yeah, I mean, I'm just looking
Exactly.
at whatever.
Yeah, exactly. Yeah.
So even though COVID hit, revenues just continued to increase, and
Yeah.
they just basically injured themselves with an overpriced acquisition and a lot of debt. Um, um, Up until that acquisition, I see this is a company which in 2014 had about 60 million in revenue, and that grew to 600 million to June 19, and and this was basically just the strategy of buying small mom and pop companies at low multiples, and these being rolled into a public entity which trades at pretty much double the multiple. So that was their
Correct.
strategy. This was under Malone, the CEO.
Yeah.
Then something that's done in a lot of sectors. One thing that I didn't like looking at the pre-COVID history is that Malone was doing this. he's using up a lot of cash flow to do acquisitions. He's raising money at the same time, and then he's also paying a dividend. I mean, that to me is kind of a little bit of a red flag. Do you have any insight into
Yeah.
why was he bothering even paying a dividend? He
Well,
should have
first of all,
used that money.
yeah, first of all, he wasn't raising money through capital raises, right? And so Malone came in. I'm sort of, I think 2012, 2013. So AMA was a small company. It had some successes, and then Ray Malone sold his five or six, body shops into the AMA group when AMA was virtually bankrupt. Right, the company was a $20 million market cap stock on the Australian exchange. Ray Malone got at the helm, and Ray Malone was extremely frugal, right? Frugal. He would do acquisitions out of running cash flows. In fact, the brilliant move, and don't quote me on the date, but I think it was 2016. He accelerated growth by getting BASF, the paint supplier for AMA Group, to put in 140 million Australian dollars to pay for all these acquisitions. So he wasn't raising money. He was virtually, you can see, look at the net debt over that period. He was constantly, he had very little debt, right? So that strategy worked like a charm, and the market cap of the company went from whatever 20 million to 800 plus million, right? So and all of that, there was no increase in share count. The debt was totally
Hmm.
manageable. He paid dividends, and this is another dynamic in the Australian market. You want to pay a dividend because if you can pay a dividend, and AMA had the cash flow to pay dividends, but if you pay dividends, then you get the attention and you get the funds flow from pension providers, right? So in Australia, you have these what they call super funds. They're basically superannuation funds. So and these superannuation funds, which are effectively pension funds, their remit is kind of limited to the Australian market, and the Australian market is not hugely deep in terms of equity. So they invest in big caps, but also in a lot of mid cap range companies. And they like the dividends because they need the dividends to pay the pensions out, right? So actually, AMA Group became a darling of these superannuation funds. And in fact, until recently, it was more than 10% owned by Australia's biggest superannuation fund called Australian Super.
Okay. I'm just going to have to agree to
Now,
disagree on making investors happy and the right moves. Just in some years you are right. 16 look good, and some of the years it looked great. But then I look to, for example, the right next year
yeah, there
he's
was one year
he's
17 or
you know
8.
he's
Yeah.
yeah 17. He's spending like 20
But
million when he just
if you look at the
generated
payout ratio, if you it only goes over 100% one year. I think it's 17 or if you look at the payout ratio, dividend payout
well,
ratio.
I look at the cash flow, and I see, for example, in the next year, like you mentioned, he's raising 13 million in debt at the same time paying 11 million in dividends, and then he does that again in the next year. He's raising debt and he's continuing to pay dividends. So he does that in the three consecutive years after
Yeah, but
that.
his
So
his debt levels are not going, are not out of control.
okay,
I mean, it's just
fair.
it's good operating. I mean, it's good. He was Ray Malone was a darling of the ASX. He made a lot of people very wealthy, but he was just a very good operator, and he was also a very good operator for equity holders, right? So over that time, he didn't go overboard with debt. He didn't, he kept within his means. He had this brilliant contract with BSF, which is kind of, I compare it a little bit to the bar tap in a pub, right? Like Heineken paying for essentially all the infrastructure of a pub. as long as you tap the Heineken, right? This is a little bit the same. The paint company is paying for your spray booth, is paying for your investment costs for these shops, but then you have to buy, of course, from BSF in this case, the paint, and that paint is about 10% of your expenses.
So Malone, he gets in the company, he builds it up. The stock is just going higher and higher and higher. It's like 10 cents. It goes all the way up to what is it, 115, 120,
Yeah,
something like that. And then I see Malone exits. What happened? Why
yeah.
did Malone leave?
Well, okay. I've spoken a lot to Malone. Malone is an interesting character. He's not an easy character to deal with in the sense he's an entrepreneur, but he's relatively brash. He's not polished. So when Blackstone came in to and gave an offer to the company, I'm sure there was some. Well, I'm not sure because I wasn't, but I'm guessing there was some hesitation. They might have said, okay, we're interested, but we need a more, kind of polished leader. Whatever the case may be. There was also another guy in the company called Andy Hopkins. He and he and Ray Malone. Andy Hopkins was also one of the guys that had like a 20 shop operation that was sold into AMA, and then Andy Hopkins and Ray Malone were running the business together for a while. Andy Hopkins wanted to go much more aggressive. I'm guessing if AMA would have, if Ray Malone would have been at the helm with this Capital Smart acquisition that sort of blew their balance sheet, I'm pretty sure Ray Malone would have probably not done that acquisition. So I'm also guessing that was in play at the time. Ray Malone wanted to not do it. The board and Andy Hopkins did want to do it, and Ray Malone said, "You know what? Because he's a very emotional guy, he probably said, you know what? I'm out of here." And he sold his shares, right? And he sold them at the absolute peak. I mean,
Yeah.
and he was a billionaire afterwards, right? Because he made himself very rich in the process as well.
Yeah, yeah. Okay. So disagreements there. He exits. I see here at 95.
Yeah,
They
so he
do.
exits immediately. Well, very closely within 12 months, they do the Capital Smart deal, and then the whole thing starts to fall apart.
Yeah. And then, Hopkins takes over, who also had some repair shops. So you basically had all these people who had the repair shops get involved with the company.
Yeah,
So Hopkins gets involved.
yeah. Hopkins is kind
And
of interesting. He did a roll up in the UK. Then he went to Australia, did a roll up again. Then he sold his roll up to AMA and became the CEO of AMA. When Malone left. And interestingly enough, Hopkins is now, well, he's not the CEO, but he's behind Repair Hub, the next biggest in Australia. so,
oh, okay.
so
Okay, so then Hopkins takes charge, but even he is thrown out 1 or 2 years later. So
yeah, so
Hopkins
what
is thrown out.
happens?
Who threw him out?
Hopkins takes over. COVID hits. Nobody drives their car anymore, so the car repair goes down. More importantly, you know um, the Australian lockdown situation meant that there was no foreign labor that could enter the market. AMA is heavily dependent on labor and labor rates, right? 50% of their cost is labor. So, there was a huge spike in labor inflation. They couldn't, hire from regional areas alternative labor. So they've traditionally been quite dependent on kind of migrant labor coming in, right? So that was during COVID. There were no visas handed out, and the whole the country locked itself down. So they were immediately exposed to a lot of cost increases. Then there was some cost increases on raw materials. Then the company lost it. Then Andy Hopkins and the board started to get into quarrels about direction and what they should do and what they shouldn't do. So this guy's Simon Moore, who was on the board and had 55% of the shares. He and Hopkins had kind of a fallout. Then
Who was that
you
guy?
know
Who was that guy?
Simon Moore. And Simon Moore, yeah, he's kind of a character in this whole thing as well, but because he got the Australian Super to invest in the company. Simon effectively bought at the peak of the company, peak of the, he bought his 5% at something like 2018, 19 when the business was in its was in its absolute peak. And so Simon Moore was sour about the way things were going, and then Simon exposed something that Anthony Hopkins had, some related party transactions and some expenses that were deemed fraudulent, and it was arguably not material. It was $1 million, and yes, it was probably in the gray zone. So that became ugly. It became well known in the press. Then Simon Moore had a negative veil around him because Simon had his sort of consulting practice had earned a couple $1 million in the Capital Smart acquisition for advisory functions. So this whole thing became messy, and it was a quarrel that they were blaming each other. There were rotten tomatoes being thrown back and forth. The press loved it, and the whole thing just became uglier, and investors lost confidence.
Did AMA lose customers? Any key accounts? Did other
No,
people catch up with
because
them?
you have to remember that there are only really two customers, right? It's these two insurance companies, and the biggest customer being Suncorp in AMA's case. So no, they didn't lose Suncorp. However, what did happen, Anthony Hopkins made a very unfavorable deal with Suncorp, where they, for a period of 3 years, they fixed the prices for repairs. And of course, when the costs shot up because of wage inflation and also some raw material price inflation, they couldn't raise the prices with Suncorp. So the business was just in an absolute downward spiral because costs were going up and they couldn't raise the price for their services. And this is exactly where the quarrel started between the board and the management, because the board said, "Oh, we have to go into Suncorp and slam down the fist and break this contract. But, how do you do that without a legal battle? And there are only two customers. So there's, how can you start a fight with your biggest customer?" That's what's this thing just spiraled out of control. And in fact, when I started looking at this deal, one of the big things that I wanted to figure out is, to what extent is the insurance company, Suncorp in this case, to what extent are they going to let this thing go bankrupt, right? Because bankruptcy, when I presented this, in 2023, bankruptcy was a serious option. And I had to convince myself that this company was worth more alive for the insurance companies than dead.
Why
And
is that? Why is that? I mean, I'm thinking from what perspective? Let's say they went
from a
bankrupt.
cost perspective, the cost to service the claims would have immediately jumped up by, you know, easily 10, 20%. Yeah. And what happened was, in the deepest crisis, Suncorp, and that was one of the things that sort of convinced me that they were not going to let this thing go bankrupt. Suncorp actually participated in keeping AMA alive by giving them some slack, giving them a temporary working capital loan, stuff like that. Because even Suncorp realized that at a certain point, AMA wasn't making any margin on services for Suncorp, right? In fact, if you take the very negative view, which some investors, well, which is quite rightfully so, you could say that there have been two, if not three, capital raises, whereby the whole capital raise basically went to Suncorp, right? So Suncorp has had record earnings over the last couple of years, right, at the expense of AMA shareholders, you could say. I mean, it's a little bit too easy to state that way, but effectively, some AMA shareholders who participated in these capital raises were giving sort of money to Suncorp
What did all the
because
other
these contracts
shareholders? I
were.
mean, so there's this constant capital raising to keep them afloat several times, like you said. And
Mhm.
I think, if I remember correctly, there were some value shops involved, and they just threw in the towel.
Well, the interesting thing is most value shops, and there's some quite famous ones, right? One is Asvalor, which is a Spanish value shop. Actually, the founders of that are old Best in Fair guys. So, you know, they were still shareholders, right? They were all hanging under 5%. So there were a number of value investors in there. But for them, the position became nothing, right? They had invested at, some of them, at 80 cents, at 60 cents, at 50
Hmm.
cents. But the position had become so small that, you know, they weren't even looking at this anymore. Or they had a junior analyst looking at this thing.
Wasn't important to their
However,
portfolio.
yeah, because it became irrelevant for them, and this is one of the things that I did with Andreas, who also goes to the Cyprus event. And it's probably I can credit it more to him than to myself, but he said, well, why don't we call all these guys and see what's going on, right? And that's exactly what we did. We started calling all the investors and saying, what is this, right? Is this still a position that you guys are looking at? And frankly, I sent them my presentation from 2023, and I said, look, if I'm right, I think you could recover quite a bit of your losses here, right? But you just need to, have faith in that the business can fix some of the stuff that's currently wrong.
What do they say?
Well, they got interested, right? And in particularly one of them, which is a small cap activist fund in Australia called Thorny. They had a 4 or 5% position, and we had a couple of conversations with them, and they decided that they would go. They increased their stake to 7%. And they decided to sort of, well, I wouldn't say double down, but they decided it was worth, doing something about this.
Where are we are now with the company? Are they done with capital raising? Do they need more? Because I'm kind of worried a little bit, just because I was looking at that July 24 capital raise, just looking at the
Yeah,
release, and they say it's to use to pay down debt, but then they say it's also for future working capital and growth requirements. So, that question that came to me is like, well, does this translate that, you know, operations will still need cash, or am I just, reading, being too conservative, or reading too much into this? I mean, do you think they're done?
yeah. I mean, I think your concern is partially justified. You've got to remember that these banks have been looking at this company, and ever since you know, ever since 2019, say when they put in their loans, they've just seen an absolute disaster. It's been this slow moving train wreck. So what is a promise worth from AMA? So with that background, they're going to ask for, okay, we'll give you $50 million to pay down the convertible debt holder, and when they have to put option in March. But you know what? We want it in escrow. You're not allowed to touch it. We'll extend your loans to December 2025. However, you know what? Pay us down 50 million, right? It's this distrust that's been, that's the result of just reckless operating and reckless management decisions in the last 4 years, right? That why would these senior debt holders believe anything that this management is saying, right? Even if it's a new management and they on paper they have the track record to do the transition, and there's a new board. 100% of the board has been cleaned now, right? So and in fact, the board is now is represented by people that were board members when in the heydays of success, right? So on paper, if they can pull off the trick again, it's a pretty good board, right? But why would a senior debt holder believe all this, right? They just want, they want to be sure that they're not getting the short end of the stick again. Well,
So
actually, let me rephrase that, because they never had the short end of the stick, right? They just don't want this thing to go pear-shaped for them, right? And who knows? Maybe it's part of the workout groups of these banks, right? I don't even know, but it could be. They're in the penalty
okay,
box for sure.
so and then I think at some point, Malone is Malone back?
Well, he's not back in an operational role. He's back as a shareholder. You can see on the cap table, but he's a 3% shareholder. So he
Okay,
believes he believes
so then
in
Malone, he grew the company, exited, re-entered, then sold again, and now he's back in for a third time.
So what happened? He sold at the peak, right? Then he bought back in at the absolute bottom in 2023, when there was a new capital raise, fully underwritten at 7.5 cents, 55 million Australian dollars, and the stock was trading at somewhere 3.6 was, I believe, the lowest, but it was trading at roughly 4 cents, right? So
So
really
wait, they
awkward.
raised at seven when it was trading at four.
Yeah, exactly. I have never seen something like this in my career. So I was immediately thinking there's got to be fraud, right? Or there's got to be something completely wrong with this company that I don't know. So that was that was one of my first missions after Cyprus in 2023.
So
Why are people
it's like a
selling?
bailout. They bailed out the company.
Correct. But it gets even you know more odd, and I can't confirm this is the truth, but so Australian Super had 10%. Well, actually, they had more, but let's say they had 10% of the company. They participated in the 7.5 cent offering, and at the same time, they were selling at 4 cents and even below. So this was absurd, right? And I was trying to figure out with Andreas, I was trying to figure out like why, right? Why would you do that? In my view, and look, it sounds very weird, but if Australian Super had not participated in the capital raising event of September 2023, the company would have gone bankrupt. They would have essentially gotten zero or very little. So they had already made the choice to sell this because it was a microcap, right? It had become a microcap. So it was out of their mandate. In my, I'm speculating a bit. We didn't talk to them. But I'm guessing it was out of their remit, right? They subscribed because they knew that otherwise the business would go bankrupt. At the same time, they were just, they said, look, we want out of this position, and we're willing to take a loss on that. And those were the shares that I ended up buying.
This is the this is the you said the Australian Supra.
Yeah, super. Yeah, Australian Super. It's Australia's, as far as I understand, biggest superannuation fund. So they were holding upwards of 10% stake in AMA, and they sold by November of 2023. They sold down to zero. They basically dumped all their shares.
So for people listening, the this Australian Supra is some. Can what do you know about it? Do you know what's their role? Why
They're a pension fund.
they're
Right?
they're a pension fund? The reason I'm asking about this Australian super fund, because
Mm.
it's a I'm just trying to also understand the incentive they had to do this. Because if I was the insurance company, I could, somehow see the reasoning that, somehow the cost of them, bailing out AMA was offset by the losses they would have had, whatever. But for the pension fund to do this, did you see, is there any connection? It sounds like, fraud, or, just, you know, weren't they at risk of being told that you're not acting in the best interests of, the pensioners? Or
Well,
why would they do this? Why would they care?
for them it was a zero, or or sort of get some recoup some of your investment. But your question is a valid one. Is what would they get questioned about this, right? Could there be, I don't know, legal ramifications for them? Yeah, that's a valid question.
Hmm.
I mean,
I wonder if
Australian
there's
super.
anyone connected with them. Is there anyone connected with
No,
them?
no, but yeah, we were looking for sorry, we were looking for fraud, right? We were suspecting fraud, but we didn't. Well, we had no reason to believe that. Yeah, they have 341 billion under management. So it's absolutely huge.
It could have just been, I guess, some sort of admin mistake where they just subscribed to these things, and at the same time, someone
Well,
else was making a decision to
it's a very
sell.
bureaucratic organization.
Yeah,
that would
so it
be
could be
that would be
just.
funny. Yeah.
I
that,
wouldn't be
that would be
surprised.
if the left hand didn't know
That
what the right hand was doing.
Yeah,
Yeah.
yeah. That's interesting. Well, it worked out for AMA, that's for sure. So you know,
Yeah.
um, so who's in charge now? So who's steering this boat right now? Do you trust them?
Yeah, so they had a CEO, and they had a COO. So one of the things that when I talked to management and when I talked to the board, I said, "Why do you have two functions? Right? This is a small cap stock. All you need to do is operate." So what they did was they made the COO CEO, right? Which I think makes sense, right? The CEO is a fairly young guy, but he's a good operator. He's hands on, right? He's close to the factory floor. He comes across as a nice guy, blue collar ish, right? So he's the type of guy that you want. That he looks at costs. When he talks about costs, you believe him that he's actually chasing cost reduction.
Hmm.
He eats his own cooking, right? He's the guy that he's not suited up. He's not eating and dining and whining and dining in 5-star locations. He's so do I trust him with the business? Yeah, I mean, he's good. Hopefully he'll grow, right? With Should the business get back on its feet, and should the business go back to growth mode, hopefully he'll grow, and he'll be the guy that can pull the car forwards.
Yeah,
Right now he's got the blessing of the board, and he's also got the blessing of, to the extent that that's even relevant, but Ray Malone, right? So people are happy with him, right? So I've spoken to him on several occasions. He's a good guy, and
so,
yeah.
and one of the things I noticed is, they segment parts of the business out, but I'm thinking, why are they even bothering? It's all repair.
I asked them that question a while ago as well, because well, their answer, whether or not it's satisfactory or not, I sort of buy it. But they said, look, when we deal with insurance companies, we don't want them to sort of, okay, so the Capital Smart business has a lot of fixed contracts with the insurance companies, and they don't want the other collision repair divisions to get bucketed in that same category of discussions.
So basically, they're doing this as part of their negotiations with the insurance company,
Yeah.
and basically what they're doing internally, they're just providing it also to the public. Okay, that makes sense. Okay, now going back to the operations themselves, I was looking at what the company looked like in 2019 versus June 24 end, and I did not take into account occupancy expense or the leases just to see what are the main costs and how's that gone over time. And I include raw materials, employees, professional services, and other. And I looked at, after just those expenses, the margin fell about 3%. And that 3% is basically attributed to an increase in the raw materials as
Mhm.
a percentage of sales. So, what are these raw materials? Why is it going up? Do you have any view?
Yeah, they had, and I don't know the details of this, but they had, particularly after COVID, they had some. Well, a lot of their expenses, about 10% of their expenses relate to paint, right? So that's a big raw material cost. And then, of course, they have to buy, panels and lights and windows and whatever they use to put into these repairs, right? But I think so that 3% is that it feels on the low side, but okay, that's yeah, that's
Another way to look at it is basically their revenues went up in the last 5 years, went up by 47%, whereas raw materials went up 58%,
yeah,
just looking at the raw
yeah,
numbers.
okay, and that makes sense. So they have been able to increase, the cost of repair somewhat, right? And also there's another trend in the industry where the even though the numbers of repairs are going down, right? And some of that has to do with all these what they call ADAS systems, right? So there's a constant decline in accidents over the last few years. However, the cost of each repair is going up because there's more and more sensors in the bumpers and stuff that actually breaks. Used to be a simple $400 repair, and now it's like $2,000 repair because there's all these sensors in there. So the cost of the revenue is going up, right, because of some of these effects. However, the raw material cost has gone up a little bit faster because of some of this inflation. They haven't been able to pass through those.
So I guess
You
there's a
know,
little bit of a risk here because the two biggest costs, raw materials and employees.
yeah,
They're both going up. Even employees slightly was just in line with revenues. So
yeah,
going forward, in order for them to increase margins, they're going to have to, either somehow keep those costs down, which it seems like both the raw material costs and the employee costs seems like a little bit out of their control.
yeah,
So it seems that the only thing they can really do to increase margins is basically increase prices.
exactly. Yeah, I mean all the other collision repair shops in Australia have exactly the same problem with staff and also raw materials. In fact, there's a little bit of an interesting dynamic going on that a lot of these mom and pop repair shops, it's like the Chinese restaurant, right, where they have 10 family members working in the shop, right, and there's no real you know, there's no real wage cost reflected in the business, right? Because it's just it's the whole family working for nothing, and whatever happens to be left over at the end gets sort of used to feed the family. Some of these small repair shops have something very similar, where it's the father and the son and the wife running these shops. So they've had less wage inflation suffering than for instance AMA has. But okay, that's a different dynamic. But yeah, a lot of those costs are out of their control, and that's not where you, as long as they're the lowest cost provider, of services, they're fine. So then the only thing left is to negotiate better deals with the insurance companies, and that's exactly what they're doing, and get out of
Could
these
they
onerous fixed fee, um, contracts, right? So Anthony Day had fixed the insurance, some of these contracts for 3 years, right? Now they're going to a 1 year, package of claims which have a certain price, and then the next year there'll be a inflation adjustment, and there'll be some renegotiation. So now that these contracts are being adjusted on an annual basis with whatever's happening in the market.
um their occupancy expense, their leases, have they said
Hmm.
anything about bringing those down? Because those are quite significant, and maybe they can squeeze out, you know,
Yeah, yeah. So they've been looking across all their divisions, and they have, they call them Project Wallaby, Project, whatever. They have all these projects, but one of the big things that they're looking at is how to optimize their service points, right? So shutting down service points that might not be needed, and they still have a few mothballed service points as well, right? Which were mothballed during COVID, and still haven't been reopened, right? So they're looking at, okay, should we reopen them? Should we just permanently close them? Should we close others and reopen the ones that are mothballed? So they're going through that exercise as we speak, and that's a major part of operational improvement going forward.
they have a 9% target for
Yeah,
margins in
and
4 or
now
5
it's
years. How
five
do
now.
they Yeah, so how do they go from 5 to 9? Have they said anything?
Yes, so they have these projects, so they're looking to improve, in the order of, well, they had that, you can read it in their reports, but these operational improvements, are to gain, like the one project has like 20 million EBITDA enhancement per year for the next 3 years, through alignment of supply chain, through alignment of, outlets, through the other thing is, if you have outlets, if you optimize your service point, you can also rotate your staff around, which is a big thing, right? So maybe one shop has a lot of activity, because there's been a storm or whatever, there's been some incident, and there's a lot of work there, and you can shift your staff around. So they're looking at optimizing all of this. They're looking at, getting putting more pressure on the supply chain, right? They're looking at renegotiating the paint contract with BSF, which currently is a rebate structure, and they want to go back to the days of Malone, where basically BSF give $140 million, or whatever they agree to, upfront, to use for acquisitions and working capital and the likes. So they're doing a whole bunch of these kind of programs that that will increase the margins to sort of what the industry would expect, which is 9% plus, right? In the US, it's actually slightly more. It's more like 10 to 12%. But okay, if you look at historical, AMA was about 9%, right?
I was looking at that.
That's EBITDA margin, by the way, and that's after lease.
Yeah. So,
So they've set themselves a
pre-COVID.
target to achieve that in 3 years. They're currently at five. Does that seem wild? No, not in my view.
Yeah, they could get there. I think, you know, if they also, they don't experience any, I'm guessing if there's no recession, or, there's no hiccups. So, because it seems to me, on the one hand, there's things here to like. On the other hand, it takes some thinking. It's not I in my head, at least, it's not exactly a no brainer, because cash is important, and
Mhm.
in order to, I guess, for the stock to re-rate and the story to get attention, they will have to be, cash generative, and does that could result, I guess, in maybe probably slowing the growth of the company. So it's more like they have to find these, the story has to change from one of growth to one of efficiency,
Hmm.
and self-sustaining themselves without needing more cash, in order to basically re-rate from their current multiple back to where it was pre-COVID. And I think you've said around 9 times, 9, 10 times,
Right.
if that happens. And one thing probably people who aren't aware of is their net debt has come down from the last capital
Yep.
raise. So the net debt has come down to 27 million. And that's without the leases, correct?
Yeah.
Okay, so your pitch is basically, company makes about 50 million, as is you put a 9 multiple, that comes out to about 450, and it comes out to basically an equity value of 9 cents roughly versus
Yeah.
6 today. And if they're able to increase their margin, then that could get up to about 15 cents in a few years.
Correct.
Now,
Because
yep. Now, one question I have for you, I'm going to put you in a tough spot here, maybe. If your base case in a way is 9, why didn't you sell at 9 when it got there?
that's a that's a mean question because after the event last year, I did buy. My average price was probably around 4.5 cents, and I had the option. It touched 8.8 whatever in November, right? So things were looking pretty good, and you know, shouldn't I have sold, right? You could say, yeah, I should have sold, but one thing is liquidity is a bit of an issue, right? So could I really have sold at 8.8 cents? But it would have been fantastic, right? Make sort of a double double and more in 2 3 months, right? That would have been a pretty big
Home
return.
run.
But yeah, that's a home run for sure. But yeah, so the liquidity would have probably, I probably couldn't have realized the 8.8. And then, I would have also sold out of a position, which I probably would never have bought back into, right? Considering the size of my current position. And I would have also signaled to the other shareholders and the company that, my actions were kind of fickle, right? In a way, one of the reasons for the other shareholders and the company being open to some dialogue and me asking some questions about how things are going or why they took certain decisions, that would have fallen in a different light, right? So but the scary thing is they did another capital raise recently, and effectively I had to double down to stay in the game or accept a dilution, right? But I decided to double down. So that's when things got a little bit harrowing, right? An already big position. If you then have to double down, that surely that's a test of conviction. So yeah, should I have sold? Arguably yes, but I think there was also good reasons not to. And you know, by the way, that recent capital raise. Okay, so the company is essentially debt free because you may have picked up, but there's also one of the business lines that they're selling, and they're probably going to get a price in the range of the remaining debt. Right.
Oh, what are
So
they selling?
they're selling ACM parts, which is the parts business. They were kind of that was like an internal purchasing arm, you could almost say. It actually came with the Capital Smart business at the time. So these ACM parts was supplying OEM parts, refurbished parts, so parts that they take out of scrap vehicles and they put into other vehicles.
Hmm.
It was
But
doing
why was that
consumables.
operating at a loss?
It's a tough business. Um, AMA didn't have the focus, didn't have the scale to make that really work.
Was that just
It's
selling to within AMA, or was it selling also to other
it's about
repair shops?
60%, maybe a bit more, is AMA. Sorry, no, it's about 60%, 58%, I think, is AMA, and the rest is selling to others. And there was a bit of yeah. Your question is a good one in the sense it's a bit of a strategic story as well. If you're selling parts to mom and pop shops or other, even competitors, sizable competitors, they're sort of frowning at you because you're AMA, right? Or you're an AMA affiliated company. So why would I give you, then AMA has competitive insight, right? Because they know what the selling price is of these parts to their competitors. So there's a bit of a strategic dichotomy there that it didn't make sense for AMA to have that business because they were not the right business to sell that stuff to their competitors. Um,
Will their
yeah,
costs go up because of that? Will their costs go up?
I would argue it's the opposite. Costs may go down because effectively AMA was subsidizing the business.
Okay, so then they're going to sell that. They're going to get some money. Is that
Yeah,
money
yeah.
um,
So
uh,
that money is going to get used effectively to, well, it'll bring the net debt
fund
down
the
to zero.
operations?
Yeah. So then, what are we looking at today? We're looking at a company with net debt zero. It's got a turnaround story in place, right? Partially in place, but it's got more legs to go. But they've proven that they can get the operational improvements done. EBITDA has been improving over the last couple. Our margins have been going up. EBITDA has been improving over the last couple of quarters. In my view, they've done raising money. It's a clean balance sheet. It's the people successful in the old days are back at the helm. They're invested, right? All of the guys at the table now have significant stakes. So the board members have 2-3%. Ray Malone has 3%. Actually, sorry, the board members have 4%, 3-4%. There's an activist investor in there. It's the thing is set up for success, right? Uh, the only problem is that the share count is very high, right? So I think it's still a multi-bagger, but maybe I was thinking multi-bag as in maybe 4 or 5x. Now I'm thinking 2-3x, right? Because basically their share count went up double, right? So taking that into account, the story is a little less exciting, but in my view, it's a re-rating story that I could believe can happen, and it's an operational improvement story that I think is is pretty straightforward. Sales are, let's say, $1 billion Aussie. Price today is, the market cap is 300 or and some change, or well, some change taken off. Right, it's under 300. So that's 30%, right, of sales. So if this
Hmm.
thing goes to, doesn't have to go to one, but if it goes to 60% of sales, I don't know. No matter how you look at it, and look, it's a bit of a fuzzy logic thing. Fuzzy, you can spin it any way you like, but you can see this thing going to 6, 7, 800 in market cap, right? In the next,
Yeah, I think it's about them delivering. No one's going
yeah,
to believe anything
yeah.
until they start delivering. Once they start
They've,
delivering, once they start
yeah,
showing cash flow,
yeah.
the market will start to look at
And
back at
and
this.
remember, they've been delivering. Probably this is the fourth quarter of meeting whatever their guidance was, right? So they're finally, doing what they promised, delivering on that. So they're very, very careful right now in making any promises to the market. They're lowballing everything. They're sandbagging everything so that whatever they say, they can achieve, right? Which is the right strategy because they've lost all credibility in the market. All. I mean, nobody's looking. Well, you and I are looking at this thing, but it's completely in the. This thing is
It's
forgotten,
small, it's illiquid,
unloved, illiquid.
they
It's
messed up,
messed up.
multiple management changes, competitive
Fraud.
market.
You know.
The list goes on and on. So it's definitely one of those crazy, interesting stories. And then I guess it's up to how each investor, if it fits into their what they
But
like or don't
this
like.
is
I
the
know
kind of stuff that I,
you and
yeah.
Andreas are like really taking big positions on this, and I do
No,
wish it works out for you guys.
but this is the
So
kind of
if
stuff that I like, right? I mean, I was saying in Cyprus last week, how many people in the world are looking at this thing? 20, 50? I don't know, 100? I think it's probably less than 50, right? So, and how many people are looking at Nvidia, so
yeah,
here at least, can I outrun 50 people? Tough, but maybe, right? I've done or Andreas and I have done a fair bit of scuttlebutt or primary research or whatever you want to call it. This is where I think I can have an edge, right, versus other investors or other players in the market. And would I put all my money in a basket of these kind of things? No.
I hope
I
not.
also own. No, exactly. I mean, this is a big position because for me, it's a high conviction opportunity. It's kind of unique. It's under the radar. Nobody's seeing this thing. So I have comfort here. But if I would hold 10 of these in my portfolio or five of them, I'd get pretty nervous, right? So, you know, but but I honestly believe here is where I like looking at these things because here I can justify my edge, right? And I cannot justify my edge with a stock like Nvidia, right?
Yeah, yeah.
My
So what if if there's any big fund managers listening to the podcast and they want to come in contact with you in order to help out or something with yeah, this adventure to join you and Andreas, how would they contact you?
Well, they can contact me through email is arthur@gridcap.com. My Twitter handle is or X handle is underscore AVDL.
Okay.
And yeah, that's it. Or they contact you, and you know where I am. That's,
All right, man. Well, thank you very much for your time. I hope you enjoyed this,
no, it was fun.
and I'll see you next year in Cyprus.
Yeah, I'll be there. Looking forward to that already.
Great.
Great, thanks.
The podcast episodes should not be copied, distributed, published, or reproduced in whole or in part without the prior written consent of the host. These recordings are for informational purposes only. This recording does not address all risks. The podcast is not intended to be relied upon as a forecast, research, or investment advice, and are not a recommendation, offer, or solicitation to buy or sell any securities or to adopt any investment strategy. The views and opinions of any podcast participants are subject to change and are not necessarily those of any companies affiliated or associated with the participants. The participants cannot guarantee the accuracy of the information in this podcast and has not independently verified the accuracy or completeness of such information or the assumptions on which such information is based. There is no guarantee that any forward looking information will come to pass. Reliance upon information on this podcast is at the sole discretion of the reader and or listener. Past performance is not indicative of current or future results. This podcast is being made available for educational purposes only and should not be used for any other purpose.